For the Wall Street Exclusive, I'm Joe Springer, helping you make informed decisions so you can succeed in the market. I want to tell you two things about management. Two more that we've been talking about management. Here's two more things. Companies don't change their worldviews. Don't look for companies that change their worldviews. Companies may even hire outside consultants to tell them something new, but they won't listen unless they already agree with them in the first place. Hiring, mentoring, promoting, modeling behavior, all reinforce a company's worldview. Apple is about the only example of a large company changing its worldview, and even there, the change was partial. They fired a lot of people and brought in a whole lot of new executives, and still they didn't change everything. Companies don't change their worldview or culture, and there's the cockroach theory. This usually applies to accounting errors. So meaning if you see an accounting error that makes things look better than they actually are, that like if you see a cockroach in the kitchen, there's going to be more cockroaches. You're probably going to find more of these errors. Well, that same sort of thing, you actually can apply that to a company. If you have an experience with a company, even a large company, you can extrapolate a little bit about that company's values or culture. If you have a good experience with a company or a bad experience with a company, you actually can extrapolate a little bit about that company's culture and values. Okay. So because of the reinforcing phenomena of hiring, mentoring, promoting, and modeling behavior, companies don't change their worldviews or culture. They actually become more like themselves over time, okay? So you get all that. They only hire the people that see things that way. They only promote people that see things their way. They only mentor people that see things that way. You get all that. Okay, so that's the first thing. Companies don't change their worldviews. The second thing I want to say about management is that there's operations and there's capital allocation. So there's operations, meaning how do you run a business, okie dokie, and then there's capital allocation, meaning what do you do with the profits? And that, of course, is very, very important. So here might be the first three things that management maybe should do with their profits. Do they sink the profits back into the business in a way that gets a good return on the money? Or instead, are they keen enough to know when money would be better spent buying back stock? Okay, so that's the second thing, buy back stock. The third thing, do they pay dividends when the money can't be spent well in the business and it is not an advantage time to buy back stock? Okay, so this capital allocation is what Berkshire Hathaway is all about. Warren Buffett does not meddle in his managers running their businesses, but he does not let them allocate capital. That's his job. And he has shown the best record probably ever of allocating capital well. And that's why Berkshire Hathaway is so successful. Okay? And then another thing you can do instead of investing in your own current business, instead of buying back stock, instead of paying a dividend, you could do an acquisition. Thing is, acquisitions usually don't work. At least they don't work as well as they are billed when they are consummated. A good acquisition comes at the right price and integrates well with the current business. And integrating the two businesses together is usually more difficult than planned because of cultural and technological differences. In sports, sometimes you see the most notable and celebrated coaches taking on a player that might be considered a problem player, and the coach might be thinking, I can fix this guy. And CEOs are kind of like coaches. They're not lacking in self-confidence, and sometimes maybe they do acquisitions that they imagine are going to go better when they do them, and then they don't. Okay, so management has to take care of operations as well as allocate capital. You like a management team that shows when it invests in the business, it gets a better return than it would have if it would have bought back stock or paid a dividend. And acquisitions generally don't work. So look for a solid record of making acquisitions that do work or just not making acquisitions at all. Okay, so companies don't change their stripes. When evaluating management, you want to make sure that they're good stewards of your capital. Companies don't change their stripes, their worldview, their culture. When evaluating management, don't just look at operations like, hey, this person knows about the oil field business or whatever. Look at how they allocate capital. Do they only sink it back into the business when it's going to get a good return? Do they buy back stock at the right time? Companies are notorious for buying back stock when it's at the top. And if there's neither of those two things, will they pay a dividend? That's a great thing to do with the cash as well. And then are they judicious about their acquisitions? Okay. I hope you found that helpful. I'm Joe Springer for the Wall Street Exclusive, helping you make informed decisions so you can succeed in the market. Coming up next, we're going to go to the laboratory and learn about biotechs.